Good day, all. Ira Epstein with your financial market wrap-up, and this is for Monday, September 30th, 2019, getting on to 4:45 in the afternoon. That's p.m. Central Daylight Time. Before I go anywhere, I want to wish a Happy New Year to all of our Jewish viewers and followers. Best to you, of course. Now, trading volume today was somewhat off because of the Jewish holiday. A lot of Jewish people go to their synagogue today, and a number of them go tomorrow as well. Things get back to normal on Wednesday, but it'll be more or less getting back to normal tomorrow. The more religious part of the religion goes again to synagogue tomorrow. But as we look at these markets, you can see the metal markets, the wipeout continues. You know, this was a month of extremes. We always say that September can be an extreme market for the stock market. It was actually the supreme crazy market in the metal markets. I can't say enough about the energies. You do recall that on September 14th or so, the Saudi oil fields and refinery was hit, 5% of the world oil impacted. You've dropped, and I want to use that word, dropped dramatically since that time, as the Saudis have miraculously, and I don't mean that facetiously, they've done one heck of a job. Their trading arm is saying they are back up to normal. The question is, how do they protect themselves from more drones? And Russia's coming to their rescue with a new weapon system that they may well buy if they've got something there. The stock market, a strong update. Now, we hear the volatility. You also hear that October at times isn't good to the stock market. Well, that is true in history because 1929, the market crashed in October. And of course, we had Black Monday in 1987 take place in October. But barring that, when you really look at history, no, it's not a terrible month at all. And now the question is, does this market, which acts good and it's within striking distance of all-time highs, get a pep rally out of the Chinese with pork and bean purchases? And by the way, there was more soybean purchases today by China, and they did remove tariffs on another 1 to 3 million metric tons of soybeans. So they are doing an aggressive amount of buying, and we know they need pork. But this is now the week of their celebration of the 70th year of the Communist Party. I don't expect an awful lot to go on. We'll be waiting when the delegations are coming, who's coming in those delegations, and can we make partial deals? It might be at the point where everybody benefits from that. When we look at the S&P, you can see on a closing basis, the highest we've been on a weekly chart on a close is 3024.5. We are about 50 points away at 2978.5. When we take a look at a daily bar chart, as nice as today was, you still had a general slope to the downside. And when you look at the swing lines, they are still in a bear mode. You have to take out 29.95 to negate that, but the way this market's set up, it cannot turn bullish by doing so. It can negate the bear pattern. It can't start an up pattern because right now, at least, you'd need an outside day up. You'd have to take out today's low and high and take that out to get the swing line to turn up. So barring that, 29.95 1/4, that'll be the number where I think bears get concerned that they're on the wrong side. That is interesting because the 18-day average of closes, which I call the line in the sand, is right there. It's at 29.91 or 29.90.75. It'll be up a little bit tonight, the way the math of figuring out a moving average goes. Support's back at the 100-day average, and where's the Bollinger Band? You tell me what you hit on Friday. I want to come back to this. This is where the market was on Thursday. You're always looking to see the first challenge of a Bollinger Band because that's often where pros take some money off the table. I did not use the word always. It wouldn't be right. It's not, and because it's not right because I'd be saying it. It's just not how it always works. But more times than not, you get to that and you're getting into an area. Here it didn't work. But if you look on the upside, it did work. You back off from it. You hit it. You're backing off. You hit it. And today you rallied off of that number. That's my point. What about momentum? Momentum, which was pointing down, is starting to go sideways here. So the market, starting off on the first day of October, interesting, in a downtrend, bias down, and I'll call momentum still down, but stalling a little bit. In the NASDAQ, we went down back here to the combination, and that was last Wednesday, of the 100-day average and the lower Bollinger Band. I'll stick with what I know. First challenge of that combination is often a point where the market finds a bit of support. It rallied back to the 18-day average, that line in the sand, where I think pros might have sold it, and then you're looking if it falls again for that support area, which you hit on Friday, and today you got to bounce. I still say that the market's in a downtrend, hit downside, momentum flattening out here. In the Dow, never did get to that Bollinger Band. You've kept the downtrend with lower highs, lower lows. Should this market get over 27,043, you negate the downtrend in the market. In terms of the swing line, you'd be over the 18-day average, but like the S&P, you can't turn up. You'd have a lower low, higher high pattern unless, and I'll repeat it, you had an outside day up, which, because I created how the swing line works, I know the workings of it. I'm not saying to expect that. In fact, outside days up or down are not the norm. So we'll see what happens in the market here. Resistance right at the market, 26,962. You closed 26,901, but I know the market was higher than that going into the close. It was up about another 40 points from there in the last trades of the day. Remember, the settlement's at 315. And then and that's when you know the settlement price, but the market reopens at 3:30, trades to 4 o'clock, and it was a bit higher. In the Russell, we're into key support area of the combination of the 100-day average, the Bollinger Band. The resistance is down, the trend is down, but you're very oversold. I think the pros are coming out of the market like they did in the other indices on Friday. We'll see if there's another leg that they can make, but you'd have to embed the slow stochastics for me to get super bearish. Again, I think that the pros are hitting and going short on VIX calls. First challenge of the upper Bollinger Band. The buyback, in my opinion, and it could have happened all at one time here, is the 100-day average, not the 18. It's the closest of the 100 or the 18-day average. That doesn't mean that the line in the sand, 1523, won't be important, but I think they're probing that market. As I've said before, selling these calls is a lot riskier than selling puts when you're down at a low level like a 10 or 11, because falling down to an 8 or so, you haven't been there. That's what I'm getting at. But it is risky, and it is something that I think that was done. In the T-bond market, we have an uptrend, higher lows. You can see the market's trying to figure out, is it going to make a lower high here? Now, what turns the trend down is if you take out 161.5. Therefore, I think the pros will try to support their positions here and try to get it over this 163.10 area. The problem for them is you're overbought. You've got a big jobs data number coming out on Friday. Is that going to influence the Fed with all that's going on? I see this market as in an uptrend, but I don't see it as powerful to the up as it could be, and I think under 161.5 attracts the bears in the market. When we come to the 10-year note, I see an overbought market that is stalled out against the 18-day average. I've got lower highs, I've got higher lows, lower highs. I hate that pattern. If you take out 130.13, I think the bulls come alive. However, you are overbought. If they're going to do anything, they've got to look wherever that Bollinger Band comes in. What about the bears? Well, if you take out 129.28.5, under this current pattern, you'd have lower highs, then lower lows. The question is, would momentum turn with you? The bias would be down, and then you're putting into play 128.18. We get to TLT, and it has an outside day up, but it's overbought. What's the rule on an outside day up? If you take out the low of an outside day up, I call it a bull trap, and I look for the nearest of the key moving averages to be hit or a Bollinger Band. In this case, the 18-day average would be the number. So 141.38, but getting there might be a sign that the futures market's already gone through those key support areas. So we know what shouldn't be taken out, and that to me is valuable as can be. If the bulls are doing any buying in this overbought, that's a number I think today's low they don't want to see taken out. Dollar index, we've got 4 days in a row over the upper Bollinger Band. That's a lot. It gives me a 1% chance on my rule of thumb of it closing over it tomorrow. That is not a reason to be bearish. It's a reason where I think bulls have taken some money off the table. Month end, so on, so forth, overbought. The odds of staying over a Bollinger Band top, that's this black line, are 5% of the time. my own rule of thumb is that when you get consecutive closes, I take away 1% for each consecutive close. I have 4 of them in a row over that. That gives me a 1% chance tomorrow, 99% on my rule of thumb, of the market staying over that number. Could be a sign where pros come out of some of these shorts. And how many days under in this number, the eurocurrency? We were under today. On Friday, you were not. You finished at 110.10 over it. So nothing excessive here. That's my point. This market's still bearish, but very oversold. If the dollar backs off, this might rally a little bit. Is this market on its way to the 108 level is something I brought up last week, and it well could be. In the British pound, the trend is down. The market's got lower highs, lower lows, resistance at the 18-day average, but terribly oversold. Not even close to embedding. Oh, by the way, the support, the lower Bollinger Band, 122.74. Japanese yen, this is what I professionally call an ugly chart. And that happens when you get an outside day up and you take out that low. That often leads to a challenge of, first of all, no trend. Second thing, of the closest of a key moving average of the lower Bollinger Band. And that seems to be what the market is trying to work its way down to. To get away from this pattern, you got to get over these highs right here, and that's quite a ways off. Bitcoin in the October contract now. I think this market today was an important update for the market. It got back over the Bollinger Band, outside day up, to get the bears nervous. This is what you had to do. You could go back to the 18-day average. You're not embedded. You have an oversold market that spent a long time under that Bollinger Band. We can see that you closed over it on Friday, I believe, at 80.35. No, that was under it. 80.94 was that. You were under it. I can't get back. These charts don't go back far enough for me to do it. I don't even know if I want to keep covering that, but it's where I think a low is coming in. The differential between December, and you got to move to December Brent, November's last trading day now. So you've got to look at this at D's versus D's to get a clean spread. The difference is 527. You're still carrying a premium with upside bias of Brent versus WTI crude, but all of the energies have come down. Here was a market at $68. Going into that attack on the Saudi oil and refinery. You are back down today to $59.19. That's a $9 drop. And no, I would have thought, like so many, well, the damage is probably greater than the Saudis are saying. They said they could be repaired at month end. I'm reading reports, no way, they can't get the parts. Boom, they got the parts. In WTI, coming down. So here you were pushing $64. You're under $54 today. $10 drop in that market, straight on down. So I guess what we're saying is that world supply is still not in line with the market. But I looked to see where the market finished, and I wrote about it in my report, month to month, from the August period to the end of September. What if I tell you they're about the same price? So this was all noise. But the Saudis have done something. They have taken the market off the lows by about $7 this year by cutting back via OPEC the production that they've done. And they just did another 700,000 barrels a day in September of production cuts. Gasoline down to this key number, and it's been fighting here, the 18-day average of closes in the 100. The trend has been down. Momentum is still down until you take out 163.35. I say the bears have control. If they can mount an attack on these prices, could you go back into the 150 area? Last to nat gas, and we had been talking about that this rally, Mother Nature is the enemy here, because you get into this late September, early October time frame where the weather in the East Coast and the Midwest is typically not hot, nor is it cold. And the air conditioners go off, but the heat isn't needed, and you build supply, and that's what's going on here. But you've gotten down to key support areas. I'd be a bit cautious. That doesn't mean you can't go lower. They're still burning this stuff and creating it like there's no tomorrow. And because the weather's still good, I don't see a big demand coming in. Resistance back into between the 100-day average and the 18, still in a bear trend, but in an oversold condition. You know, we write about all this, and we write about it all day long via a team here that I think you'll find pretty good. People don't realize, we have 2 meteorologists on staff. And what they do for us is they're giving us idea about the hurricane season, what's going on with the frosts at this time of the year, are they coming in? And we cover this whole spectrum of commodities. So if you're sitting there and you're waiting to get reports, let's say on a Monday morning, you've already got a bunch of these Sunday night for you. Yeah, a bunch of them. When the markets are open, we want information in your hand. That's what our clients get, and that's what you can see if you're not a paid subscriber to our research yet and or a trading account of ours. We'd like to let you see what our clients get, and you make up your own mind, but I think you'll see. It's well written for commodity traders. You get to see what the producers are using, the end users, the speculators, managed money, and so on. How do you get it? Just simply go to our website, sign up for free offers. You can click here. It'll take you to that page, click for free offers, sign up for what you want. We've made it really easy to do so as well. We'll take it the rest of the way. I'm Ira Epstein. You have a great day, and I'll see you tomorrow.